Recently, Moody's was the last of the major credit rating agencies, and there's 3 of them, to downgrade the United States credit rating. Now, we're going to talk about what does that actually mean, and then how can that really impact your mortgage rates. So first, what does it actually mean? Well, when you downgrade credit rating, think of it kind of in personal world as your credit score or your credit rating. So effectively, the last major credit rating agency finally said, hey, the United States, it's like you went from a mid 800 score, now you might be like 799. Now you're in the high 700s for personal credit score if you kind of kin the two. And ratings of sovereign nations, they go from AAA rating now down to AA1, which means that you're one step below what effectively is a perfect credit rating. Now, Moody's did this, and they've had it for the longest period of time. Back in 1919, I think is what we read right for it, is when they gave the United States its AAA rating, and they finally downgraded it. Again, the last holdout of the 3 major agencies to do so. Now, the others had actually changed the credit rating in the United States in the past too. Back, I think it was 2011 or 2009, we actually saw a downgrade, but then it came back up, and then back down again. The United States, from Moody's, first time to go from AAA to AA1. Now, how does that actually impact, say, mortgage rates or just the general creditability for the United States? Well, by downgrading the credit rating, what that means, theoretically, putting on my economics degree, that means that all of a sudden now the United States has to pay more to borrow. So all of a sudden it's like, again, paralleling it back to a private credit rating or credit score. When your credit score goes down, it generally makes it so that you have to pay a higher interest rate when you're trying to borrow for cars, houses, etc. But at a national level, what that means is, hey, we downgraded your debt from AAA to AA1. It generally means that if you're going to borrow money from other countries, typically in the form of treasury bonds, then you're going to have to potentially pay a higher interest rate. Now, some folks were like, oh my gosh, it's going to increase rates dramatically. The treasury yield's going to go way up. But remember, Moody's was the last of the agencies to do so. So the other 2 had already done it, which means that we already had factored in some of that risk. Why did Moody's wait so long and finally do this? Well, it was the most recent fiscal uncertainty and the monetary policy that you have Congress talking about that gave them the uncertainty to say, hey, we're going to cut this back, meaning that I think their words were effectively around Congress is struggling to make sure we maintain a long-term balanced budget. We see that being a risk for the future repayment of United States debt, so we're going to cut back that rating. Kind of think of it again as someone rating your credit, going, okay, hey, we know right now you're making some very poor fiscal decisions and decisions on planning for your budget in the future. We're going to lower your credit rating a little bit, meaning, hey, you got to pay a little bit more because we're a little more uncertain as to what your future looks like. That's effectively what they said by downgrading the United States credit rating. Now, how does that impact mortgage rates? Tying that back to what we deal with all the time in mortgages. That generally means that we're going to see higher interest rates on mortgages. And in fact, right after that announcement came out, they did pop a bit. Now, it wasn't as extreme as if, say, all 3 agencies at one time downgraded the United States debt. Remember, it was already downgraded by the other 2. However, it still did impact rates, and it rose them a little bit. So the major thing is, you now understand a little bit more on how credit agency ratings can impact the ability for the United States to borrow, and then how that translates to our mortgage rates going up. It's because now, effectively, all the rating agencies are telling everyone else in the world, hey, we see a little more uncertainty in the United States being able to pay back its debt. So everyone else is like, all right, cool. Rather than us giving you this super low interest rate, we're going to still give you a low interest rate, because remember, it's still a very high rating, but it's going to be a little higher interest rate. We demand a little bit more money for the extra risk we're taking, because all the agencies now, credit rating agencies, are saying that there could be some potential issues in the long run with the United States paying back its debt. Still remember though, from AAA to AA1, when there's a boatload of other ratings still below that, again, it's kind of like going from a 800 credit score to a 790, 799. Still a very good rating. However, it's not as good as being in those 800s. My name's Evan Kaufman. Hope this helped explain. Take care.